of course, ahead of next week's Federal Open Market Committee. Joining us now is Krishna Guha, Evercore ISI Vice Chairman and Head of Global Policy and Central Bank Strategy Team. Krishna, great to have you on the show. What are the key
Likewise, great to be here.
What are the key data that you're watching this week, especially given the fact that we do have this media blackout from the Fed, which kind of creates a little bit of a vortex in terms of how it's going to be analyzed, this data analyzed by the market?
Yeah, for sure. So, look, we're looking at two tracks. You've got the macro track and you've got the credit track, both equally important right now since the bank stress began. On the macro side, obviously particularly focused on the PCE read, but also the employment cost index. This is the gold standard measure of wages. And it's more important than ever right now because the other two higher frequency wage series are telling very different stories. Average hourly earnings cooling off nicely. Atlanta Fed wage tracker, not at all, staying hot. So a lot of interest for me in where that ECI print comes in. Could be a little firm, let's see. And then we're all poring over the credit data. Now remember here, the Fed has something we don't have. They have the Senior Loan Officer Opinion Survey, the so-called SLOOS. They will be poring all over that before the Fed meeting. We only get to see it after the Fed meeting.
So is it a foregone conclusion that next week we are going to see the Fed hike another 25 basis points? Is really the debate now about whether next week is the last hike we get and then we see a pause, or whether we see more on the table potentially into the summer?
Yeah, so it does feel very much as if the Fed officials have coalesced around the idea of doing one more 25 in May. And the sort of signaling that we had right up to the beginning of the blackout suggested that either they've seen a first cut of that Senior Loan Officer's Opinion Survey, it's not that bad, or they have enough comfort from the other data, including the private data from the bank supervisors, so as to feel that it's going to be okay to go forward with one more hike, even if that SLOOS, that loan officer survey, is pretty ugly. So as you say, the real debate inside the committee right now, it's not about 25 in May. It's about what signal do you send?
Okay.
And how do you frame the outlook for hikes beyond that?
Krishna, I want to ask you about the debt ceiling. So nobody can say that we didn't warn them on this one. I mentioned earlier there's a spread between 1 month and 3 month T-bills, indicating that at least in that market, some people are starting to get concerned. Do you think the market overall is taking seriously either the possibility of default or the possibility of a lot of volatility around a potential default? And if you're an investor who's not so optimistic about Washington figuring this out, what do you buy? What do you sell?
Yeah, so you guys have been all over this, and rightly so. It's a very big risk event ahead. Look, the market, I think, is approaching this right now as if this is a play where everyone acts their part, but at the end of the day, we don't get the default. I think that that's a reasonable baseline, but it does omit one key thing, which is the market has a role to play in this drama too, right? The politicians need the market to throw a tantrum at the last minute so that they have an excuse to compromise and climb down. And I worry that the market has been too sort of relaxed about this, too relaxed to want to throw that big tantrum, which of course makes it more likely that we would go over the cliff. So not a base case, but a real risk here.